Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and just like the mortgage interest rates, Zillow is going to flip-flop within 1 week, and you can mark my words on that. It seems so many people have forgotten that we are currently, the United States of America, right? You've ever heard of it? We are currently fighting 41-year high runaway inflation. Obviously, the mortgage rates are going to continue to trend up because they have to, regardless of so much political pressure. Now, there are so many things that are going to be coming out from now between the end of the year that are going to impact mortgage interest rates and the federal funds rates, treasury, bonds, MBSs, all of those things. So it's really important to understand what data to review. Now, you guys know I'm reviewing the 10-year, but what happened this week was job numbers. Job numbers were twice as good. Double, right? How do you get that wrong? Double what the projections were. Because of that good news, that's going to signal to the Federal Reserve that they can tighten more and raise the federal funds rate even more, like they should have said when they talked to the public. But instead, we got a dovish Jerome Powell. It is what it is. Now, what we're really going to want to pay attention to is August 10th and the CPI numbers. If the CPI numbers exceed 9.1%, that means we're not at peak, and that will again trigger the Federal Reserve to be more hawkish, to raise rates faster, to raise rates higher, and to do more tightening. And that's what you're seeing right now. So all eyes on August 10th for CPI. Again, a lot of people are expecting 8.8. If it's over 9.1, that means we're not in peak inflation, and the Federal Reserve will tighten even more, which they're already going to do because job numbers. But regardless, you guys, we're going to dig into an article today from Zillow titled "Mortgage Rates Drop on Slowing Economic Activity." And like 1 day later, we got those job numbers out, and they're like, wow, the economy is doing really good. So Zillow just can't get it right. Zillow can't get it right. Zillow's flip-flopping with the mortgage interest rates clearly, right? So what does all of this mean? I'm going to tell you what all of this means. It all means that I'm not your financial advisor, even if I want to be. But my bio, you guys, my bio is as a realtor, beast mode, stud, amazing loan officer, instructor of all things real estate, all in Texas, husband, father, victim of '08, current renter, owner of real estate, owner of a note, shark fisherman, content creator, thumbnail maker. Those are the things that I am. And currently I'm trying to find my own primary residence because I've uplifted my own family, my wife and children, and I've told them, let's downgrade right now into some crappy rental and wait out this market. And my wife said, okay, honey, I trust you. So that's a lot of pressure on me. So in other words, you guys, I'm walking this out right along with you. Don't forget that. I put my money where my mouth is every time. And if you guys could, for my efforts, you know, I try to get you a video a day, sometimes 2 videos a day. Like this video for me, subscribe if you haven't, hit notifications, and please comment below. I love you all's comments. I absolutely am blown away by them. It keeps me going. It keeps me wanting to do more content creation and wanting to do more videos. So don't stop it. But let's get started on this article right now. And it's going to be a very brief read today. You guys know I absolutely hate reading because quite frankly, I suck at it. It's really embarrassing, actually. But let's read this right now. Mortgage rates dropped significantly last week. The Federal Reserve increased the federal funds target rate by 75 basis points at the July meeting, in line with market expectations. But comments from Fed Chair Powell after the meeting were interpreted by many investors as more dovish than prior communications, which is a problem. In addition, several economic indicators pointing to a slowing economic activity. GDP declined for the second quarter in a row, which spells recession. Why our current administration and Federal Reserve will not acknowledge that is so disappointing to me. It's like a lack of accountability. It's a lack of acknowledgement. Yeah, no one's even saying that they did it. Just acknowledge it. Acknowledge it's here. Anyways, new home sales slowed and consumer confidence dropped due to inflation and recession concerns. Investors reacted by driving longer-term rates, such as yields on 10-year treasuries and mortgage-backed securities, lower. Psych, it changed the very next day of this article. But anyways, predicting the Fed will have to slow down rate hikes and and potentially ease rates sooner than previously expected. Wrong. Primary mortgage rates fell in turn. This week's markets will be focused on additional comments from the Federal Reserve members to understand both their commitment to fighting inflation and their willingness to potentially further slow economic activity as a result. Jobs data later this week will provide an update on how tight labor markets are and could influence investors' expectations on future Fed actions and views on recession risk. And here's where they got it wrong. Here's where so many people got it wrong. Those job numbers that they're referring to came out and doubled expectations, meaning there were twice, it was 500 and some thousand jobs were entered into the market in July. Now, the Federal Reserve doesn't want to see that. The Federal Reserve wants to see things tightening and slowing down. Again, we're fighting inflation. So because that didn't happen, the reverse happened. It actually was double what they were looking for and hoping for. Now it's putting all of the eyes back on the Federal Reserve and saying, you're not doing enough to combat runaway inflation. And now what they're going to do is, again, all of those political pressures versus the logical pressures, we're going to have something in between, right? We're always going to have something in between. Everyone knows what we should do. We should just raise rates 3%. Just do it, 300 basis points. Let's be done with it. Let's get uncomfortable for 6 months. After 6 months, reset. Put a couple things in place so it doesn't happen again, right? Whatever. I'm just a normal person. I'm a YouTube geek. What do I know? I barely even own a property. But where I want to close as I want to show you guys the Treasury bonds right now, so I can further explain to you how I'm getting the information that I'm getting. But again, before we look at this, understand that regardless what the Federal Reserve or the administration says as far as what they're going to do with quantitative tightening and rate rising, remember, we still have 41-year runaway inflation. That hasn't gone away. That hasn't slowed down. Remember why we're doing the things we're doing, right? That's what so many people forget. They see that slight drop in rate. Oh, it's time to buy before I lose my opportunity to buy. That's wrong. We haven't even started yet. But let me show you guys these Treasury bonds right now. So again, you guys, I'm looking at this 10-year. Now, my anchor point is 3%. If this goes over 3%, we're knocking at mortgage rates in the 6s. If this is under 3%, we're usually knocking on interest rates under 5.8%. Lower, slightly lower. Now, my estimate is by Thursday of next week, we're going to be sitting at an average interest rate of 5.48%. Now, that's what I'm saying, you guys. I'm also going to throw up a poll to see if you guys agree with me on the interest rates and where they're headed next week. Now, obviously, we've had decline, and now I'm saying increase. So decline, increase. So far, I've been right as far as my trajectory predictions, except for one time, the last time the Federal Reserve met. When they raised the federal funds rate 75 basis points, I anticipated residential mortgage rates also going up, because at that time, I believed that was the trend. But here's the thing. I didn't think that over the last 2 weeks, because I've been watching that 10-year. I've thought that, for the last maybe month and a half, that, the next meeting here in July or last week, that the rates were going to shoot up. I was wrong. The market had actually already priced in what the Federal Reserve was going to do. And I think that's very interesting to point out. Now, you guys, I want to end this video with just a few conclusions that I've made from reading this article. Now, the first thing is, and I'm talking to everyone here, don't be overly optimistic and immediately run back into the market. I want you to be overly prepared instead of overly optimistic. Now, number 3, 3 months before you see yourself purchasing a home, you need to start getting prepared. And what I mean by that is interview realtors, find the best realtor that you can find, but also pre-qualification. You're going to want to get pre-qualified 3 months prior to when you think you're going to start looking. So if there's anything wrong with your credit, income, or assets, you have time to do something about that. Plus, also, if you don't get the absolute best terms on interest rate, then during that 3-month period, improve credit, stack money, you lower your DTI, right? But you need time to prepare. If you wait to the last minute to start getting prepared, qualified, interviewing realtors, it's a joke. You shouldn't do that. There's so much pressure already on buying a house to wait to the last minute to do like the really, really important stuff. Don't do it. Do it whenever you're ready. Now, I'm going to start that more than likely in November, and I'm going to do a series on my channel, and I really hope you guys watch this. I'm going to do a series at every single step that I am taking from November forward. My target date to purchase is going to be February. So I'm going to start getting ready in November, and I'm also going to probably more than likely sell my truck. I'm going to sell my truck, and here's why. We're in a car bubble too. The car bubble is crazy. When the car bubble pops, my truck ain't going to be worth as much. My truck is paid off. I'm going to sell it. I'm going to liquidate. I'm going to get that cash, and I'm just going to finance another vehicle, but I'm going to downgrade that vehicle tremendously. So I'm still going to have a car, but I'm going to take my truck and all that profit, and I'm going to use those proceeds to purchase a real estate. And I'm going to show you guys every step of the way. I'm going to show you how to talk to your loan officer. I'm going to show you how to negotiate. But again, for me, that starts in November. So stay tuned. Now, other than that, you guys, I appreciate you watching this video. I appreciate you following along with me on this journey. And if you're out there investing in real estate, I wish you luck and I hope you win.